What's going on, everybody? In this video, I'm going to be breaking down what a fixed index annuity is and how it works. Also, be sure to stay with me to the end of this video, and I'll actually show you the calculator that I use that makes it a lot easier to understand how these index annuities work and how they compare to the S&P 500. My name is Ethan Nico, the co-founder of Scenic Financial. Be sure to hit that subscribe button if this is your first time here. Also, hit that bell to be notified when I post videos every week and so you don't miss any future content. So basically what a fixed index annuity is a hybrid between a fixed annuity and a variable annuity. On one side, you have the fixed annuities that grow at a safe rate. On the other end, you have variable annuities that track the market and rise and fall with them, and there's no guarantees protecting you from losses here. The fixed index annuity is right down the middle. It provides you with a floor of 0%, just like in a fixed annuity, so you're not going to lose any money in the contract, but also gives you the potential to earn money when the market does good. So it's going to basically track a market index just like a variable annuity does, and you're going to get some of the gain when the markets do good. These index annuities are a really good middle-of-the-road option for people getting closer to retirement or may even be in retirement and want to dial back their risk level so they don't risk losing their principal, but also know that they need to earn more than what you're going to get in that fixed annuity, CD, or money market account. So this is the perfect tool for that. You can protect your wealth while still having some market participation and gains. Now let me flip over my screen. I'll walk you through a couple of different things to help you understand the concept better. I also show you my calculator that I use so you can see for yourself how it works and how it compares to the market overall. Alright guys, so now this is my calculator that I talked about earlier in the video. This is what I use to really help people understand what a fixed index annuity is and how it all works and how it compares to the market overall. So what we have here is an index being tracked. So this is the S&P 500 without any dividends, right? So this is not including any dividends on it. This is what the S&P 500 has done since the year 2000 until the year 2018. So we see the average is 2.8%. One other note is this 2.8% is what the actual return would be over that time frame, not the average rate of return, right? So this is the actual return, not the average. If you don't know the differences between an average rate of return and an actual rate of return, then click on the video up on the right hand side. It'll be somewhere up here. You should see a card pop up and you can learn more about that. So when we do these calculations, we want to use what the actual rate of returns are because averages aren't real. What this is showing is if we had 100,000 in the year 2000, it would have grown to 169,000 over that time frame. So as I mentioned earlier, fixed index annuities typically track market indexes. For this example, we're going to look at the S&P 500. So we're going to track this return here. So when I hit this button, it's going to turn it on. And the first thing to pay attention to is this up here, this 50%. This is just the gains captured or the participation rate. So what this is saying is when the market goes up, how much of it is mine? So for this example, we'll just use 50% right down the middle. So if we look down here, we see that the first year was 0% return, and that's because the market lost money. So remember, the key benefit of using an index annuity is anytime the market goes down, you're going to get a 0 return. So instead of losing money like we did in that dot-com bubble burst, we kept our money flat, right? So what we did there is we transferred the risk of the market over to the insurance company. So the insurance company had to take those losses for us. So the trade-off for that, and this particular one doesn't have any fees associated with it. So the trade-off is in terms of the gains, right? What kind of benefit do I get when the market doesn't go down? And what kind of benefit does it get when the market goes up? So we see here in the year 2003, the S&P returned 26.4%. Over on the right-hand side, we got 50% of that 26% return. So we got 13.2%, right? So we're only going to get half of the gains. So you see that every time the market goes up on the left-hand side, we're only going to get half of it here on the right, all the way down. If we fast forward to the total, we see that the index annuity in this case averaged 4.5%. While the S&P only did about 2.8. Now remember, this 2.8% is the real return of the S&P 500, not including dividends. If you actually did include dividends into this calculation, this would actually be about 4.7%, so just slightly higher than the more conservative option here on the right-hand side. What this tells you is that even though that index annuities are considered a more conservative option, and we're going to give up half of all market returns in exchange for no losses, over the long run, we can average, in this case, about 4.5%. So now that's not a crazy return. And you see in this case, it does a little bit better than what the market did, not including the dividends. So understand this is not always going to be the case. And the reason we don't use dividends when we calculate the S&P 500 return is that's how these index annuities are based. They're basing on the actual S&P 500 return, not including the dividends. So we're trying to compare apples to apples here. So if the S&P 500 returned 26.4%, not including the dividends, we're going to get 13%. So these are the actual results that you'd get from those. Now, a couple of words of caution with this is the gains captured, or the amount of the upside you're going to get, will depend on what interest rates are doing, what companies or products you select. So it's important to do your research on these things, and keep in mind that every company has the right to change these. So if interest rates were to continue to go down, you can see this 50% change over the years. Also, these index annuities are typically long-term contracts. You're going to be stuck with them from anywhere from 5 to 12 years depending on your state. So also something to keep in mind before purchasing one of these. But as you can see, if you are willing to invest for the long term, you can use a conservative account and still have a pretty decent rate of return over the long run. If you want to play around with this yourself, there's actually an online version that you can use for free. So just head over to Google and you want to go to moneychimp.com. I'll actually put a link in the description below. Basically, once you go there, you go to this site here and you'll see this calculator. It is basically the same thing you just saw earlier, just an online version of it. You can actually play around with the numbers in here. And what this is showing you is the difference between an average rate of return that we all see in our statements and the actual return. We'll go ahead and change this. You can see that the 2.8% that I was looking at earlier, this is where it came from, right? The actual annualized rate of return on the S&P 500 in this time frame was 2.8%, and this is what it was without any kind of dividends. So remember that annuities don't include dividends in their calculations on the indexes they track. That's why we use S&P return without dividends. Now, if you were to actually go in the market yourself or buy some sort of index fund or a mutual fund, you would get the dividends. So your rate of return would look more like that. So a whole 2% more. So we see that that index annuity actually got 4.5%, and that's without any fees, because what are the fees in this case? Most times the fee is the market upside that you gave up for that protection, right? So your fee is the 50% of gains lost. So this 4.5% is your real return. Whereas when you look at what the market returns with the dividends, this doesn't include any fees. So once you lump off 1.5%, depending on if you have an advisor and your actual investment lineup, you can see that your rate of return's going to be somewhere, under 4%. So you have to ask yourself, is it really worth it for you to be paying fees to keep your money in the market and taking on that risk and hope that you're going to earn an extra 1 or 2% a year? Or would you be better off using a safer approach like that index annuity, where you can protect yourself from those losses and still get some of those gains and not have to worry about paying those fees or any kind of market downfalls? So when we look back at the calculator here, we see that 100,000 got dwindled down all the way to 59,000 in just the first 3 years, where you'd stay flat in this case here. So even though you're giving up half of your upside potential and you only got 13%, that 13% was based off of this 100,000, where in the market you would have got the full return at 26.4%, but it's based off of only 59,000 because you lost the money in the previous years. So even after you had that double-digit rate of return, you're still only 3/4 of where you started off with, where you're up by a whole 13% in the more conservative option. And see, over the long run, you're going to end up with $230,000 here and $169,000 here. All right, so now this isn't always going to be the case. Again, interest rates change. If we only got a 40% rate of return, we're going to see that this drops down to 3.6%, still outpacing what the S&P 500 did. As we get a smaller participation rate, we'll get closer to what the S&P 500 did. We actually go down all the way to 30% to be about even with it. You can see that these things are a pretty powerful tool when it comes to preserving wealth and protecting from market losses. All right, so now you guys know what that fixed index annuity is, how it works, and how it can benefit you in the long run. If you're trying to figure out where can I get one of these or what are the best ones out there, then in the description below, there's a link to apply to become one of my personal clients, and then I'd be happy to walk you through the different options out there and see if it's the right fit for you. If you're interested in learning more about annuities and some other types that are out there, then click on the card here, and remember that your future depends on what you do today.